Yeah, so I've really been paying attention. I think as everybody has to the market and the news and what's going to happen. Although I don't digest a lot of news, I definitely have been paying attention to the vaccines and how that is going to affect things. And I looked at the Anderson forecast, which is near and dear to my heart, and something that I follow. And they just put out their forecast for Q1. And they had a really positive and robust forecast for the economy in general. And so, the basics of what I interpreted were that these vaccines, as people became inoculated and were less fearful about COVID, the economy was really going to have a nice run and a pretty robust run for a pretty, for at least a few years. And so I thought that it was pretty positive as far as the outlook goes. And I immediately thought, man, a great economy probably means higher interest rates because, my thinking in that, Daniel, and I'd love to get your insight, and I'm certainly no market expert, is that as people have jobs and as the economy gets stronger, I think the consensus is that rates are going to start to rise because everybody believes that they are too low right now, or the lowest that they've been. No one can argue that. So as the economy can handle more, those rates will start to come up as the Fed stops buying these mortgage-backed securities, which is partially what's making rates so low. And so that's one interesting thing, and kind of my thoughts on that forecast and just kind of the vaccines coming out. And to that end, the Fed met yesterday, and I think everyone was just kind of watching and waiting and digesting these notes. And the market yesterday was just kind of up and down with every little nuance that was spoken. And I didn't watch it, but I did watch the market, and I saw the rate alerts all day long. And, the message was basically more of the same. And I feel like, if anything, the market was reacting to what wasn't said rather than what was said. And so I think, Fed chair came out and said, hey, we've got to be honest about inflation, and they haven't seen any movement in inflation, have had a very difficult time doing that. And so, it seems like the consensus is that rates are going to stay low for at least the foreseeable future. And when and how and if we get movement is a huge mystery. So it seems very puzzling. So how can you clean that up for me, Danny? And what are your thoughts?
So Mark, I agree. There's a lot kind of packed into this. And as Tribe members, anybody watching this, really, we know that you're here because you have a commitment to this business, a commitment to growing your expertise and kind of hammering on your craft. So the first thing that I'll say is that I could probably talk for 90 minutes just to unpack what you just said, Mark. However, What I'll invite this group to do is there are more expert voices than myself or Mark in this space. Specifically, a friend of Tribe, Barry Habib, would be who I would reference everybody to, and his commentary in MBS Highway. If you look back through his predictions and analysis, he's extraordinarily accurate, and he does a very good job distilling the information that you need to truly be an expert and then pass the information on to your clients. So that said, I'll do my best to just distill down what I think are the important takeaways from what you just shared, Mark. So the first one is you're absolutely right. When the economy starts doing well, rates are likely to feel pressure from that effort or from that action. And the reason that pressure will be felt is because of all of the action that was taken to stimulate the economy is highly likely to create inflation. And again, this is where I will not do it justice, and I would invite you to look at Barry's commentary. But if you think about a bond investor, which any of the end investors of mortgage-backed securities are investing in that bond, which is a fixed return asset. So they buy a mortgage that returns a rate of, let's say, 3%, and they're expecting to earn that 3% over time. The market forces don't allow them to earn more than 3%. They're committing to a fixed return. However, if the market starts to have inflation, meaning the value of the money that they're earning doesn't allow them to buy the same basket of goods or services, then it really puts the real value of that 3% return slowly over time erodes, and it erodes at a rate equivalent to the rate of inflation. So as an investor, if you want to keep the same rate of return. Let's say I want to buy the same basket of goods and services with my money, with the money that I'm earning on a monthly basis. I need to increase the rate of return on my fixed return asset, which means I need to see the yield or the rate that our consumers pay increase to offset that inflation. So we know that when inflation comes back, the rates will rise. So the question becomes not, if rates will go up, but when. And what we're finding is that despite all of the efforts, right? So if we just do simple math here, right? And this by no means is actually how the economy works. And we saw this in 2013 when the Fed bought mortgage-backed securities and there's a macroeconomic concept that I will not bore you all with, which is called the M1 money supply, which is basically the total quantity of dollars in the market. So if you think about inflation as a function of supply demand for dollars, if there's twice as many dollars in the market, you'd expect every dollar to be half as valuable. But that's not what actually happened when we saw this event happen back in 2013. So now we're going in and we're kind of taking another bite at the apple, having quantitative easing, which is the act of the Fed infusing capital into the economy in the form of purchases of mortgage-backed securities. They're doing it at another kind of level that has been never seen before in 2013, never seen before again. And so we'll see if we see the same reaction in the macroeconomy as we did back then, which was not a lot of movement, right? Since then, we've seen steadily sideways interest rates. And if we continue to see that again, all predictions are that 2021 is going to be a fantastic year for the mortgage industry, maybe not quite as good as 2020 from a margin perspective, because we've had the opportunity to bring new people into the industry from a capacity standpoint. But with the Fed continuing to buy, right, adding to that demand side of the equation, meaning that rates can stay low because there's people willing to buy at those low rates in the form of the federal government, or the Federal Reserve, I should say. And there's really no sign right now of inflation coming to the forefront. Expecting sideways movement, maybe, knock on wood, even a slightly lowering of interest rates over time as some of the margin that's been built into the market starts to drain away and we kind of get to kind of more normal levels. The consumers might experience a little bit lower interest rates. So all that is to say, more to come as this evolves. This is something that all of you should be keeping a very close finger on the pulse of, because it has a dramatic impact on your business building, on your team building, and on your client experience. So definitely keep yourself educated around this, learn some of the terminology that it's going to allow you to explain to your clients what's happening, because when rates start to come back, the movement starts to happen upward, in the past, if we look at the times where rates have gone down, they typically drift down slowly, but they go up quickly. So we need to be prepared and our businesses kind of insulated against that. And the things that we talk about in part of our tribe, mantra, tribe coaching, is really about how to winterize your business and keep yourself from being subject to the ebbs and flows, because you have such a incredible client experience, such a tight referral network, that you're not a victim to the circumstances that are out of your control.
Yeah. And I'm going to go just one step further, simplify all that and say, hey, rates are going to stay pretty low in the near term. As the economy starts to recover and you see unemployment go down, you're probably going to start to see interest rates go up. And to simplify that to a client, you just say, hey, rates are low right now because the economy is struggling. When the economy is booming, rates typically are going to rise as well. And so don't try to time the market. Let's harvest these savings and get in. Next year, you're probably going to see less refis, still a booming purchase market. So focus on that purchase market. Really try to capitalize while you can and educate consumers who really want to time the market. And I think that you'll be in great shape if you do that. To Danny's point, really winterizing your business. Cool. So let's move on to the mindset piece.